if AI is going to be massively deflationary, if it makes all these goods so much cheaper, should we be printing a bunch of money to still stick to 2% inflation, or does that not matter anymore?
We certainly can run monetary policy the same way. So you don't automatically get deflation just because some goods are going down. You can do things to increase demand so that there are upward pressures on the final prices. Even if the AI workers are not demanding anything, you can put a lot of demand so the firms charge a lot. And not just for the services that AI is replacing, their raw minerals and all the materials that go in. Fundamentally, when you have productivity, it makes it easier for the monetary authorities, the Federal Reserve, to deliver low inflation and good growth. That's what they're trying to do. It makes their job easier. And I think it takes the pressure off them somewhat to inflate because things are going pretty good. And so there aren't the same pressures.
Right. But should they be trying to fight the deflation at all?
Well,
in that world, because we need inflation to root out the rentiers. We got to fight downward wage rigidity. But now the AIs have all the jobs, so you don't need to worry about that. There's a bunch of biases that humans have, which to get rid of, we need inflation. Do we even need that in the world with AI?
Okay, that is a very good point. Frankly, Keynes founded modern macroeconomics, and he was an incredible Renaissance person, just having sort of both sides of the brain. And one of these insights he had that just transformed things. And before, we just used these, what we call general equilibrium models, demand, supply, prices move to keep them into line. And Keynes was looking at the Great Depression and he said, prices should be coming down. And they're not. And why aren't they? And that's really a cornerstone. And at the end of the day, it's mostly human behavior. It's mostly workers. So if you have these docile AI workers, well, they're not workers, they're just, if you have firms that are willing to let the prices fall, you certainly can do that. I mean, we're going to still have some human workers. I don't know. But I guess a question on what monetary policy should be is, do you think interest rates are going to go up or down? When we had deflation last time from this demand deflation, which is what happened after the financial crisis and the pandemic, interest rates went down. I mean, my intuition here is that interest rates would be needing to go up, real interest rates, real inflation interest rates. And then deflation's not such a problem. You just don't need to let them go up as much. When we were in the interest rates went to zero, basically. And it's a whole nother line of discussion, but they felt they couldn't lower them into significant negative territory. So they're sort of paralyzed. There's this deflation or too low inflation. Monetary authorities thought they knew how to create inflation, but that's always been by cutting interest rates lower. But when they've hit a bottom, they don't. So I have a whole book about negative interest rates, but a whole nother thing. But if we're imagining interest rates to go up, it's not much of a technical, real interest rates, inflation adjustment. It's not much of a technical problem. You just, let the interest rates go up a little less so that you're not getting deflation.
Do you expect interest rates to go up? Because one factor, obviously, is you want to invest in the future. The future has so much more potential. Another is maybe you want to consume more now because you're going to be wealthy in the future anyways. You might as well start spending as much as you can right now.
I think AGI and AI are upward pressures on interest rates. So lots of crude reasons. The huge energy needs, I should have asked you about that first, having to provide all the energy needs. And also, as you say, traditionally when you did a lot of investment, it raised wages, but it's possible, and there's economists like Daron Acemoglu have, shown it can go both ways. It's not difficult to show it can go both ways. If you're really just substituting for workers, it's making capital more valuable.
Right.
Like you just even, invest more. So it's with what the pressures on monetary policy a little bit depend on that. In principle, it makes life easier. If it did push things down, the interest rate down to zero, there are interesting questions around that, but maybe your audience might not be that fascinated by them as I am.
Well, let's talk about it a little bit. I mean, if we expect interest rates to go up because of AI, what should the government be doing right now to be ready for that? Should they, should they be locking in 100-year bonds at the current interest rates because they're only going up from here?
So I'm going to get to it, but just where we are, I had been arguing interest rates today. I mean, I follow this all the time, and maybe a lot of people who listen to you don't, but inflation-adjusted interest rates. And I want to pick there's a 10-year bond that's indexed to the inflation rate that our Treasury issues. Inflation index is only about 10% of our total debt, but and it's not. There's tax stuff, and it's not perfect, but it's like a pretty good measure of what we call the real interest rate. And it had gone to like -1 at one point after the pandemic. It averaged 0 for about 10 years between 2012 and 2021. And it's higher now. And that is, for a macroeconomist, the biggest question in the world, because it affects asset prices, it affects risk, it affects volatility. So, the question, I regard it as just a normalization. I think that's something that was likely to happen. If you were to go around, talk to my younger colleagues or to other places, there's quite a debate about that. There's a lot of people who think we're getting old, we're not inventing anything. I know you're just debating against that, and good for you. But but I tend to think interest rates are more likely to go up than down going forward. And I'm talking about these long-term interest rates, not what the Federal Reserve does. It just sets the overnight interest rate. The market setting these long-term interest rates. I think they're more likely to go up. But I think AGI is only a piece of it. I think that the debt's rising everywhere, the remilitarization of a lot of the world, needing to deal with climate change. Eventually, if we're not dealing with climate change, we're dealing with climate disasters, growing populism, geopolitical fracturing, many things. I tend to think interest rates are going to go up, but not just for the good reason that we've gotten more creative and everything's going to be better.
If you enjoyed this clip, you can watch the full episode here and subscribe for more clips. Thanks.